Speaking of being ripped off for your retirement funds, this article from, I believe this was the Financial Times. I've got to go back into my print thing and figure out why I'm not printing headers and footers. Anyway, this article by John Aidan Byrne, U.S. companies spent $4 trillion buying back their own stock. I have pointed out to you that companies make a profit, and a well-run company makes a profit, and then out of that profit, typically they use that money. Some of it is distributed to stockholders, but most of it is used to expand the company, to develop new products, to build new factories, to come up with new ideas, research and development. But instead, what American companies have been doing for the last couple of decades, and this goes back to changes made during the Reagan years, is buying back their own stock, which reduces the number of shares out there, which means that the price of the shares goes up and the amount of the dividends goes up because there's a smaller share base to spread those dividends out over. And they're calling this the shock market rally. This is no market rally. This is a scam. Cash-rich U.S. companies have plunged nearly $4 trillion of their cash into buying back their stock since 2008, which is why the stock indexes are hovering near record territory. Richard Bowen, a former Citicorp executive, blew the whistle on the bank during the subprime mortgage crisis. He says it has massively manipulated the market. He points out these share buybacks in the open market were once deemed illegal. The SEC eased the rules in the first few years of the Reagan administration. Gee, what a surprise. Bowen says, this market scares the crap out of me. He told the Post. So maybe this is the Washington Post. In any case, it's, say what? Oh, this is a New York Post. Okay. Apple, which spent $7.2 billion in the first 3 months of this year on stock buybacks. Yelp just approved a 200 million share repurchase. Citigroup is just announced they're going to spend $15 billion buying back their own stock. This is just a fancy way of the CEOs and managers of a publicly traded company taking the profits of the company, using them to jack share prices so that their own personal compensation goes up. That's it. That's pretty much the only consequence. The effect on stock price and CEO bonuses makes this a win-win for management. He writes, this repurchase programs are responsible for most of the net inflows. In the 3-year period ending in 2012, 449 of the S&P 500 companies spent 54% of their earnings, or $2.4 trillion, buying back their own stock. Last year, a whopping 66% of corporate earnings went to share buybacks. Something that, as John Aidan Byrne points out, used to be illegal. There was a good reason why it was illegal, and it should be illegal again. This is a phony stock market bubble caused by companies buying back their own stocks. It's nuts. And, Randy in Ottawa, Iowa. Hey, Randy, what's on your mind today?
Hi, Tom. How are you today?
Great. What's up?
Say, could I make a quick overview of a previous caller before I get to my point?
Sure.
The guy that thinks that succession of some like Texas is possible. That we are so, because of Wall Street and money, we are so linked to Texas and insurance and financial and stuff like that it would be a quagmire, unbelievable.
Oh, it would be a disaster for both Texas and the United States. There are no states that are going to successfully secede from the Union. It's not going to happen.
Oh, well. The point I wanted to make was that understanding that you've written a book of the coming economic crisis and stuff like that, and then you made a couple of points, one about the fiduciary rule, then about how the stock buybacks, corporate stock buybacks, are, between the two, are actually moving the market higher. But yet it's inflated. It's like it's artificially inflated. Is there a point to be made between the two, that, except for the fact that we're headed down a lonesome trail once the rest of the world is angry at us and loses confidence in our financial system. So that was kind of my point. A question to you: is there some intricacy there that connects the two and is leading us down the path of destruction?
Connects which two? The inflation of the stock
rule and
the fiduciary rule and the inflation of the stock market?
Right, by the buying back stocks.
Right. Well, they're both the consequence of Republican policies. I mean, it was Reagan who directed the Securities and Exchange Commission to change their rules to allow compensation of executives with shares, with stock options. And it was the SEC that changed the rules to allow corporations to buy back their own shares to manipulate their own stock prices. These things were illegal prior to the Reagan administration for the very reason that they would encourage companies to do exactly what we're seeing them do. If you look at a graph of the stock market over the last 100 years, I mean, you see, in 1929 it kind of went up, and then 1930 went down slightly, but then it was fairly, slowly, gradually going up, but fairly steady up until around the mid-1980s, early 1990s. And then it really started taking off. I mean, keep in mind, as I recall, when Reagan was in office, a high point in the Dow would be 3,000 or 4,000. Now it's at 20,000. So, or is it 17,000? It's been a while since I've looked at the Dow, but whatever it's at. So it's just been this explosion in it, and it's been largely driven by these stock buybacks. So yeah, I think it's all the same thing. It's that we made the mistake of doing away with basically what were anti-corruption rules. And
ask another question?
Yeah, go for it real quick.
Okay, so that we both agree that there's artificial inflation in the market due to conservative agenda. Then when we look at how the gold market inflated so drastically during the invasion of Iraq, and then how it's kind of settled back some now, right. Do you have any idea, or have you ever guesstimated how much inflation is in the market that will disappear when the crash comes, or is it just something that's...
My sense of it is that the market is overvalued by about half, but I'm no expert on market valuation.
Oh, I was thinking at least 30, but yeah, that's even. Thanks for cheering me up.
Yeah. That doesn't mean that it's gonna drop to that, but the problem, and I pointed this out on Tuesday, I think it was. There was a story in the Financial Times about how American companies have reached the end of the rope when it comes to issuing debt. I mean, the American companies have literally been issuing bonds, in other words, borrowing money in the public marketplace, in order to use that money to buy back their shares. So they'll issue $100 million worth of debt. They'll take that $100 million and buy back shares, jacks up the stock price. The CEO makes an extra $1 million overnight. The company's $100 million more in debt now. But all the stockholders think that they're happy because their stock price has gone up and their dividends have gone up. And when in fact what has happened is the company has been made more unstable, and the entire economy has been made more unstable. And so it's this fire economy, this financial insurance, basically all these basic services that should be good, boring, lubricate the wheels of business services, instead have become ways to do a hustle, ways to make money. And it's not what it was intended for. It's not how you plan an economy. It's not how you regulate your banks. Randy, I got to move along, but thank you.
Hey, Tom, love your show.
Thank you.
Love your books. But I have a question on this corporate stock buyback issue. So if there's, if there's a certain number of stock certificates in existence, and the company is worth a certain amount of dollars,
right.
You have stated that you do the division, and that's what the value is per stock.
Well, yes and no. I mean, the marketplace has a lot to say about that, but that at its simplest level, in theory, that's it. Yes.
Right. Very simplistic. But if a corporation buys back, say, 10% or 20% of their shares, they don't just remove those from existence.
Yes, they do.
They own them, right?
No, no, they get deleted. They get removed from existence.
So it
They
diminishes
get what
the
they call
number
it
of
retirement.
shares.
They retire those
Okay.
shares.
Okay. But then wouldn't the wouldn't the increased stock value be a truly, or in a simplistic sense, be a true representation because there's less stocks in
Yes,
existence?
that's the whole point. Let's say you've got a company that has $100 worth of assets in a world where we only value companies based on assets. And actually, we do it a whole bunch of other things like sales and things. $100 worth of assets, 100 shares. So each share is $1. And when they do a dividend, each dividend is 10 cents. So if the company goes into the marketplace and buys 20 of the shares, 20% of their shares, well, let's say they buy half of their shares, just to make it really easy. They buy 50 shares back and retire them. There's now only 50 shares in the marketplace. The company's still worth $100. So every share is now worth $2. And because every share now has twice the value, represents twice as much of the company, of ownership of the company, as it used to, the dividends double. So instead of having a 10-cent dividend, you now have a 20-cent dividend because one share is the equivalent of what used to be 2 shares. So that's how it works, Don. I think you've got it nailed. And those shares actually do get retired. Companies can issue new shares, and when they do, that's actual money coming into the company. Don, thanks for the call.